Well, the market certainly liked those earnings. Wow, Meta's up 11% after hours. That is totally nuts. And I'm just going to go through a few of the things from the release here, which I think the market liked a lot. So I think we're kind of in bull market mentality now with Meta. Maybe not for the whole market in general, but the sentiment around the stock is pretty firmly in the bull camp. So what I mean by that is when a stock or the market's in a bull market, what happens is bad news is ignored. Something like the metaverse spend being $4 billion, that would have been terrible news 6 months ago, and now it's completely ignored. Nobody cares anymore. So bad news is ignored, bad news, let's say, and good news is great news. Okay, so I think here what the market liked, this is my take, I think they like the guidance because it shows that Meta is really coming up from the bottom of their bad year last year, and they're doing that by cutting expenses. And it looks like they've cleared the path for some growth as well. So that's really interesting. I personally think this return was okay. It was good. I like the direction the company's going, but I don't think it's a blowout, 11% up in one day. I'll take it. That's fine. And maybe I sold too early on Monday. I sold half my position this week and a few weeks ago. But I'm not really into gambling on earnings and seeing how they turn out. So, yep, I took a bit of a hit, but that's totally fine. I still got half my position that I'm going to run with. I'll just leave that position, and unless it gets totally overvalued, I'll still hold it for a long time. Okay, so just a few things from the release. The sales were up 3%. Nothing to really write home about, but I think it shows that the bottom is in. Operating income is down 15% to 7.2 billion. And the operating margin is actually down to 25% from 31%. However, there is a restructuring charge in there. So if we take that out, which I think is legitimate, operating income is just down 2% from last year. We also see the family of apps is still very profitable. They generated 11 billion in operating earnings, and this is really the foundation of the company, and they have a 39% margin on that part of the business. So that is absolutely as solid as ever, and still a lot of runway to go there, I think. Metaverse spend, like I said, 4 billion. That's quite a lot on not much revenue, 339 million. They do need the Quest 3 to come out. I think that's going to really, that's kind of going to be a big moment for them, whether it actually starts bringing in real revenue or not. So we'll see that in October. But again, nobody cares about this now. They don't care about the metaverse spend when 6 months ago, that was all anybody cared about. So this is, like I said in the last video, this is a very clear sentiment stock. This is not being driven by financials, I don't think, because it was a great company 6 months ago. It's still a great company, and the market has a totally different mentality right now. Net income's down to 24%. It's down 24%. EPS is down 19% due to the share count. That's the lower share count. Costs are down 5%, which is actually quite good. And I think that I was talking about it in the video. I said Mark Zuckerberg loves money, and he is proving it here. He's got his year of efficiency, and they're starting to get some traction with that. And it's going to get better because they have cut a lot of jobs, and that's terrible for the people who work there, and it is good for shareholders. So make of that what you will. And what else? Okay, so let's look at the guidance here. So I think this is where they actually made the market very happy. So the expenses are now estimated to be between 86 and 90 billion, and that is way down from their original expectation that they put out back in, at the end of Q3. So they keep dropping their expense guidance here, and that shows you that they're really hammering on that side of it. My estimate here is it's probably safe to expect they're going to grow by at least 5% this year, and that would put them at 122 billion in revenue. Let's say upside scenario is 10% growth. You've got 128 million. the other thing that they did mention here was that those lowered expectation or expense guidance numbers actually include restructuring charges too. So actually we only have a potential of 81 to 87 billion of actual cost built into this company. So they actually come down more than it seems like. So if we look at adjusted net income based on those revenue estimates, at the low end it's about 29 billion, and the high end it's about 39 billion. So that would put us at a current price to earnings ratio of somewhere between that's forward price earnings of 14.5 to almost 20. So again, not a cheap stock. Oops, I gotta shut my phone off here. Not a cheap stock, but definitely a fair price, I think, for a company that's this good. Now, one of the things that I should mention here is with the expenses. This company has huge incremental margins, right? And so what I mean by that is, if their revenue grows, their expenses don't move much, right? Because most of their expenses are fixed expenses that are going to be there no matter what. And that's why they can guide for the whole year on expenses, but they can't guide anything else past a quarter. So if we actually get a beat on revenue this year, maybe some of the stuff turns around, and you might see these earnings expand significantly. And so when you have huge incremental margins here, where most of the revenue growth will go to the bottom line, that potentially really adds to the profit margin. So if you look on my estimates here, in those two scenarios, you've got a few billion more in revenue that goes to the bottom line. The margin changes dramatically. So that's a potential upside for this stock. If they beat on revenue, the net income number could grow significantly from 2022 numbers. Okay, so what else do I want to talk about here? Balance sheet. There's not much to glean from the balance sheet. I didn't see anything that was super interesting there. Ad impressions up 27%, and the price is down 17, or the price of the ads is down 17%. So that shows me that they're still in somewhat of a recessionary environment in the advertising space. But what that also means is, if they get out of this recessionary environment, all those new ad impressions are going to start really adding to revenue, right? When the price gets back to normal and potentially increases as well. And like I just said, if those turn into revenue, basically they just turn into profit, right? So I love companies like this with this is operating leverage, basically. Large fixed costs, not much in terms of variable costs on new revenue, and you can get these big upside moves on stocks like that. It cuts the other way though, because if revenue drops, you're still stuck with the fixed expenses, and you can lose your profitability pretty quickly if revenue goes in the wrong direction. So daily active people and monthly people are up 5%. So that's really interesting. You've still got 5% growth happening on a huge base. And so that doesn't seem like much, but again, back to the high operating leverage, what happens is, if those 5% new users, they're basically cost free for the company, and any revenue that's generated from them just goes to the bottom line, right? So they don't increase profit by 5%. They can increase it by a lot more than that, because they're basically all profit, any revenue generated from these new accounts. So then we have buyback. This is a big buyback quarter, 9.2 billion. Share-based comp was actually 3 billion. So I think the net buyback was actually 6.2. I don't like how they account for this, but this is like GAAP accounting. It's not really Meta's fault. A lot of companies do this. So I would say that the buyback was at 6.2 billion. I'm actually a little frustrated, because they should have done these big buybacks last quarter when the price was down. I don't understand why they don't just, okay, the price is 90, buy everything you can, right? Like, I don't know why they're not doing that. If I was running this company, I had a bank account with $40 billion in it or whatever, I forgot how much is in the bank, but like, that's where you use that money, right? So Meta doesn't have a great history with their buybacks, but it looks like they might be getting a little bit better at it this year. And so then what else? Operating cash flow, 14 billion. But again, if we take out the share-based comp, you're at 11 billion in operating cash flow annualized. That's over 40, 44, plus maybe get up to 50 because the fourth quarter is typically bigger. I personally I'm more interested in the operating cash flow here than I am on the free cash flow because the Capex spend is actually directly tied to more revenue. I don't believe they have a lot of maintenance Capex in there. A lot of that is going to stuff like AI, which they think is going to expand their revenue pool. So I'm going to look at this as an operating cash flow basis. And if we look at it now, it looks like they're about 13 times, times operating cash flow. If we sort of ballpark it going forward, that's a fair price for this company. And yeah, I think that's pretty much it. The margin bottom, I think, is in. Like we saw the worst two quarters last year, and I think we might be heading out of that now, and that might continue the sentiment train in one direction. So the last thing I would say is about sentiment, bull market behavior. Like, sentiment is like an ocean liner. It starts in one direction and it gets a lot of momentum in that direction, and it takes a lot to turn it around. So right now we have bullish sentiment and we're heading higher. And in May, the stock price may come back. I actually think it will at some point, but I think that the momentum and the trend is up right now. And there's a lot of positivity around this stock. And I think it's going to take a lot to derail that. I do think actually the TikTok stuff might be priced in though. If Congress in the US decided that they weren't going to ban TikTok, I think that would actually hurt the Facebook stock price pretty significantly. So, because everyone's expecting that now, so it's mostly baked in. So I would say that's maybe a risk now, the TikTok thing. But other than that, I think all, the financials are going in the right direction. The sentiment's going in the right direction. There's a lot to like here. Just got to keep an eye on it that we're not holding into a period where it's overvalued. All right, that's it for this one. I hope you guys enjoyed the big beat today on revenue or on earnings, and we'll see you in the next video.